This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, finally. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Morning.
Hi. Good morning. It's the last day of the week, and it's been a bumper rally so far for the market. Looks like we can build on to those gains, given what the GIFT Nifty is suggesting. So I guess it's going to be a great weekend as well.
Well, that's right. We had a terrific Thursday. Let's see if it's followed up by a fantastic Friday. But yesterday was a super-duper trading session.
I mean, big gap, and the gap sustained and actually expanded through the course of the day. So, absolutely. So now the only job is to build and not give back the gains that we've kind of accumulated, because the big gap up comes after a few days of consolidation. Let's just quickly tell you what you need to know as we begin another trading session. So as I said, the Nifty yesterday broke above the previous highs, but it did so in style, and that's what matters. Not the style, but the fact that it was a big gap up, and that basically took us above the previous all-time high, and it's looking very, very good. The big theme for global markets continues to be, as we were finishing last Friday, it was, of course, the state election results. It was very local. The theme was very local and political certainty, etc. As we finished this week, it's basically the fact that the Fed has gone full pivot, right? Inflation be damned. The reason I'm saying that is because, and I said this yesterday as well, it's not as if GDP growth forecasts have been lowered very substantially in 2024. You look at some of the recent inflation data points, etc. But the Fed has completely gone full pivot. It's been an extraordinarily dovish sort of statement, and of course Q&A from the FOMC day before yesterday. Now, it's not the same everywhere else, and we were kind of discussing yesterday how the Fed is kind of the Pied Piper. The Fed was the first to raise rates and everybody followed, and as the Fed will start to drop rates, everybody will follow on the way down as well. For now, we had something coming out of the ECB. So Christine Lagarde of the ECB essentially said that no rate cuts were discussed in their meeting. I'm putting that exact statement out because if you remember, Powell said that actually rate cuts are coming into view. In his quote, exact. So, and this is not the only thing which Christine Lagarde said overnight, which kind of puts distance between what the ECB's trajectory is going to be and what the Fed is going to do. The euro, by the way, rallied. I mean, a decent rally against the dollar and against most currencies. And something similar played out with the Bank of England as well, where the British pound rallied about 1% plus against the USD. Okay, just to come back to the US session, the S&P was up about 0.25%. The Nasdaq is up about 0.19. The changes are up on your screen. The 10-year yield, that dropped 11 basis points. We were at 5%. We are at, not even 4% now. So another 11 basis point cut, 3.91. Actually, the longer end of the curve, 30-year is what sold off the most. There was about a 15-odd basis point sell-off. But this is, of course, more widely tracked, the 10-year. Dollar sold off. It's been a remarkable sell-off on the USD. At the same time, yesterday, we were talking about a 1% drop. There's 1 more percent drop, almost nearly on the US dollar index. So that sold off about 0.9%. We are at under 102 levels. Oil's up about 3%. There's been a bit of a jump. We dropped to about 72.5 recently. We are back at almost about 77 or so. More on this commodity a little later. So where does this leave us for the Nifty and the Bank Nifty? Now, the Nifty yesterday, as I said, opened with a flourish and built on the gains. So we've closed above the important Fibonacci level, which we've been putting out for the last many days, which is 21,100. We're above that, right? So where do we go from here? The upper end of there's a rising channel stands at 21,750. That's about 550 odd points away from here. That's the first kind of target. I mean, you've got to project higher now, given the fact that we are in uncharted territory, and 21,750 is that first number. This gap that I was talking about, big gap and then sustaining, so that gap area becomes the support, right? And that gap should not be filled. Otherwise, it will seem like the market is getting a little exhausted. That gap area is 2950 to 21,074. That is the high of day before yesterday and the low yesterday. So, that's basically numbers on the downside that the Nifty should not break. Resistance for the Nifty Bank comes in at 47,850. And then 48,566, which is the upper end of the daily Bollinger Band. So that is actually the more meaningful one is 48,566, but the near term is 47,850. Support for the Nifty Bank, the recent low perhaps should come in useful. That stands at 46,887. We've had a massive boom, we've had a massive rally, and in a way, actually, we are kind of leaving off one more week with very strong gains. Last week was 3.5%, and I think this week is not 3.5% on the Nifty, but it's not small either. You know, the GIFT Nifty will come up on your screen. What to do from here becomes the question. The GIFT Nifty is implying an open which is 95 points higher. You know, would you want to chase the market higher? That's the only question now. I would say the answer, at least for me, is always no. Never chase. I mean, give the market opportunities to kind of give you, I mean, tell you, provide more reasonable entry opportunities. Could be a mild, it could be a sideways kind of start. And that perhaps becomes much bigger if you're trading from a risk-reward point of view. But that's the kind of market we're in, which is going absolutely gangbusters. Sonia.
Oh, absolutely. The Fed has provided the fuel and we've now stepped on it, right? I mean, we're zooming away in the market. And that's the big question that everyone's asking across the street. What next after yesterday's bumper rally? Now, in terms of sectors, I'm looking out for a couple of pockets. The rate sensitives will definitely be in focus because now, as we head into the new year in 2024, rate cuts could be the theme because that's what the expectation is from the RBI, right? After what the Fed has done. So the focus will be on real estate, on autos, on NBFCs, and these themes are playing out already. So don't miss out on the rally here is what I suggest. In terms of individual stocks, I mean, we've already seen some big moves there. DLF, for example, is at a fresh high. You have auto stocks like TVS, which are at fresh highs. So a lot of these stocks have started to perform already. Within rate sensitives, you also have banks. So the good part is now large caps are starting to perform, and that could be the next big theme over the next couple of weeks as well. So yesterday, ICICI Bank, IndusInd Bank, DLF, all at fresh 52-week highs. Large caps are starting to perform as FIIs have made a comeback. So if you map the trajectory in the last couple of weeks, the FIIs have pumped in quite a bit. Yesterday, in one day alone, FIIs bought about 3,600 crores. In December so far, 20,500 crores was the amount that FIIs have pumped in. So these are the couple of themes: real estate, NBFCs, auto stocks, and of course the large caps that are making a big comeback. The uptrend is intact. There's no two ways about that. Maybe chasing the market may not be such a good thing, but don't miss out on the uptrend is the feeling that you get across the board. There could be a pre-budget, a pre-election rally, and you don't want to be left behind. So that's the sense you're getting. Today could be a good start. Let's see how we build on to our gains.
Well, you know, Sonia, you'll be in a bit of a dilemma whether or not you should be adding a long position. But if you have your longs, you should be maintaining it. You know, because we've consistently been getting good news for the last 2 weeks or so. And if you booked out too early, well, you'll only have yourself to blame. Now, yesterday was as good a session as any. The Nifty started off in the green and we ended virtually at the high point of the day. So that was very, very good. And both the pillars of the market did well. Whether you look at the IT index or the banking names as well, both of them did well. The IT index had to come back stronger because the previous trading session, that one was under some pressure. The FIs, what did they do? Well, they added more shorts than longs, so that's interesting because they added close to around 5,000 short contracts. But yet they continue to be net long with their long positioning at around 57%. And normally you don't want that FI net long position to go to around 100,000 contracts. Or we have seen on both ways. When it goes to 100,000 net short contracts, that time we get a big move up. And when the net long positions go to close to around 100,000 contracts, then you see a bit of a correction. Now, it's good to see that that long positioning is still maintained in that vicinity of around 35 to around 50,000 odd. That's not too worrying according to me. What are the options data suggests? In an uptrending market, you always look at the put writing. And yesterday, we did see the put writing. So 21,100 put, fairly active in trade. 21,200 put as well, fairly active in trade. Between them, they added close to around 80 lakh shares. And there was writing being seen at those levels. But since the markets are moving up, some bulls are saying, why not take a punt, spend 5, 10, 15 rupees odd, buy an out of the money call, and let's see what happens from there, because our maximum loss will be 5 or around 15 rupees. So that seems to be the case because the big addition that we're seeing at around the 22,000 call odd. What are the levels you're looking at? Since we did see some writing at the 21,100 put and the 21,200 put, the 21,050 put becomes, 21,050 mark becomes a bit of a support zone, and 21,115. What I've done is I've deducted the premium from both those two strikes. So that's why we have got that support zone out there. But the Nifty Bank, that can end this year on a high. That's going to be the big driver for our markets. And you just pull up the chart, year to date, till say somewhere around November, you had the Nifty Bank that was actually underperforming. But take a look at the move up we have seen in the month of December itself. The Nifty Bank is actually outperforming the Nifty. And if that is to continue, that's the additional booster shot that you need for the Nifty to move up. The Nifty Bank is still trading. It's up 11%. The Nifty is up 17%. If it wants to narrow that gap in there, I'll tell you what, sky's the limit. This market is moving higher, and it appears it has some business at higher levels as well. So maintain your long positioning, trail your stop loss, and just ride it.
Okay, just ride it. That's the only way to do it, right? For now, you have the markets that's starting. So let's get you some opinion as well coming up this morning for you. First up, on the equities front, Chetan Seth of Nomura maintains their view that 2024 should be a better year for Asia ex-Japan stocks. He says the three pillars of their constructive view are strong earnings growth recovery in 2024, stabilization in valuations, a softer US dollar and better fund flow environment. However, he does not think there may be smooth sailing in 2024 as suggested by market pricing, as there remains the risk of the narrative changing again. For now, he says positive momentum in the stocks may sustain in the near term.
Okay, here's some money market views now coming in. Lakshmanan V of Federal Bank says dovish pause delivered by the US Fed was embraced by most of asset classes worldwide. The 10-year fell below 4, marking its lowest level in 4 months. Equities surged. Both G7 EM currencies strengthened against the USD. Rupee, he expects to trade between 83.2 to 83.48 for the next few trading sessions.
Right, and on the bonds, Lakshmanan says the government bond yields fell sharply, tracking US Treasuries after Fed officials guided for 75 basis points rate cut by the end of 2024. With rates view moderating, domestic bond prices will probably reposition itself. Food-led spike meant our headline inflation was higher, but core inflation remained benign around 4.1% in the coming sessions. He expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25%.
Well, the markets are tending to be likely to move up, but let's tell you about stocks that we're tracking for you today. We're looking at Hero MotoCorp, PVR Inox, Shriram Finance, Saturn Credit, Army Organics. Those are the top 5 stocks that we're looking at. Add to the list, Anant Raj, Texmaco Rail, Sterling & Wilson, Genispa, all of them likely to open up well in the green, while we have KFin Tech that could be a little under pressure.